Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to talk about financials and how to steer your cannabis business, including a couple of things like convertible notes, as well as options and restricted shares. We're going to talk about bought deal offerings and highlighting the cannabis industry's focus on saving cash. So jumping into this marijuana venture article, it talks about using the financials to steer your cannabis business. When set up properly, financials show how much the company is spending and earning, and they can help you to make sound decisions on where to take the company next. The processes and systems underlying the financials determine their accuracy and whether the company has a realistic view of how it can help the business go and whether it's doing exactly what it needs to successfully grow and scale that business. So when you view the financials as the rudder for your fast-moving company as a way to check on how the company is doing and deciding on how to proceed, they can help you better manage your cannabis business, including how to budget. So without the right finance process and systems in place, redundancies and inaccuracies could be muddling up your understanding of what the company is spending, what it's collecting, what it's likely to earn in the near future. So a truly useful business is built on actual results with one or more years of data to set a realistic baseline that can be used for making comparisons and noting trends. As your budget comes together, consider what-if scenarios. It's better to do this using real data than trying to guess what your next move should be. What would be the impact of a price increase? Or if you give in to competitive pressure and lower price, what happens? And you need to keep the business accountable. So the budget helps control spending as much as it lays out the financial plan for the company's immediate future. The more these views are done and the difference is noted, the better the process will become and the more accurate these forecasts will be. Don't forget about transparency with investors. Through it all, transparency with what the business has experienced can differentiate it in a crowded field. Cannabis is a new territory for many investors, and they want to zero in on the companies that have integrity and can stand out by the numbers and thoughtfully explain what they mean. Without trust in what they're seeing, they'll move on to the next company. So the bottom line is that companies that run on factual data are able to build reliable forecasts and aren't stuck chasing the unrealistic goals or misguided strategies. Financials should provide a snapshot of a period of time when you predicted that if nothing significant changed, this is how much the company would spend and how much it would be able to take in and how it would perform. The more the company can build up its history, the more accurate its forecasting can be, ideally the right set of financials prepared for your viable future. The more a company can build its history, the more accurate its forecast can be, ideally the right set of financials prepares you for a viable future. The industry has changed quite a bit. You can't just have a letter of intent from a few different people and expect to be in business and get investment capital. And if you do, that's fine. You can always get away with something one time. But if you try and go out and get investment capital after that without a return on their investment, it's not really going to go anywhere. And so being transparent, being honest with your investor, I think is crucial, but also being realistic, having a set of expectations about pricing, about what-if scenarios, and being completely transparent and honest about that, making sure that you have somebody with financial experience on the board or within your company to be able to determine worst-case scenarios. How far could prices go? Can they reach 7 to 8 cents per gram? Yes. Will wholesale prices remain $1.74? No. And so having those scenarios, will you be a going concern? If not, then figure something out to where you have a higher margin. Maybe look at Puerto Rico for a 4% corporate tax cap to stay alive because Aurora's coming in with CBD. So if you're a CBD company and you're not in Puerto Rico utilizing a 4% corporate tax cap, then those big companies that come in are going to crush all of these mom and pop companies. I think that 2020 is going to be all about consolidation as these companies came on board without really good plans are going to essentially collapse. As seen with the convertible notes, there's a lot of them that are underwater. If you're unfamiliar, a convertible note is a debt instrument. And so it's a personal liability on the individual that will convert to equity in the company if it reaches certain milestones. So the bear market pot stocks has left billions in convertible debentures underwater, meaning that the cash-starved companies have to creatively structure their debt to pay a bill that they didn't expect would come due. The cannabis companies hopped into convertible notes in the last 3 years when their stock prices were soaring and traditional debt markets were largely closed to the untested, unprofitable, and stigmatized sector. Issuers that tapped the U.S. markets included the Canadian pot giants Canopy Growth, Aurora, Tilray, and Aphria. Converts are a form of interest paying debt that can be converted into stock at a set price, and investors generally buy them on the assumption that the shares will appreciate, giving them an opportunity to convert at a discount. If they choose not to convert, the companies have to repay the principal when they mature. Most of the time, that doesn't happen if you're a good company that's generating revenue. The investor doesn't want their money back. They want to have 10x returns with that equity. And so that was appealing when stocks were appreciating, but in the recent rout with that's been high flying cannabis stocks that left shares far below the conversion price at just a time when the cash strapped companies are finding it tough to raise capital. The advantage of the convertible market in the US gave companies two significant advantages: a quantum of capital and access to an institutional investor base. There was a natural demand for cannabis convertible notes in the US, especially from hedge funds that were quick to snap up the stocks, according to bankers familiar with the matter. But cannabis companies' high risk credit profiles meant terms were generally less favorable than other issuers at a time when the pricing environment had been stronger than ever. So the summer of convertibles in 2019 meant tech companies like Snap or industrial issues such as Fortified Corp could get a sub -1% coupon and 40% plus conversion premium. Meanwhile, cannabis converts, many of which weren't due to mature until 2023, have had a 4% plus coupon and a sub 25% conversion premium. And this doesn't even really go into real estate. So a real estate investment trust isn't able to rent, in some cases, to cannabis, creating this crazy bubble where people are paying an upwards of $25 a square foot just to have a facility. And so it's costing cannabis companies quite a lot right now. Last week, Aurora became the first big cannabis company to restructure its converts. It had 230 million of 5% notes maturing in March with a conversion price of $13 a share. They were trading at $4.38 when it announced the holders could convert early at a 6% discount to its recent trading price. So apparently 94% of the holders took them up on that offer. However, the shares tumbled 29% in the 2 days after the announcement, which diluted the shares by about 6%. So the average retail investor is probably unhappy about the dilution, but it provided an appealing option for institutional holders that can see long-term value that may otherwise have run out of cash. Aurora is not the only one. Kryon announced that it granted stock options and restricted share units to certain directors and officers of the company and its subsidiaries under the company's amended and restricted option plan, and amended and restated the restricted stock unit plan. Restricted stock units are another way of compensation. Companies like Amazon give RSUs all the time. They typically have a 2-year vested time frame, and then you'll get those shares every 6 months or so when they do vest. And so Kryon announced options and restricted stock share unit grants. And so Kryon announced that it granted stock options and restricted share units to certain directors and officers of the company and its subsidiaries under the amended and restricted stock option plan. And so that's going to try and give individuals more incentive to stay, I'm assuming. Generally, RSUs are issued as a way to pad your compensation. So if they're not generating enough revenue to pay them an appropriate salary, then these RSUs are what people call golden handcuffs, because it forces you to stay in order to get your full compensation. So Tuesday, it was announced that Green Organic Dutchman signed a deal-bought agreement with a syndicate underwriter led by Canaccord Genuity. The agreement dictates that the underwriters will buy an aggregate of 29.3 million units at a price of 0.75 cent Canadian, amounting to a total of $22 million. Each unit will consist of one common share and 1/2 of one share purchase warrant of their stock. The deal will grant Green Organic Dutchman more capital to complete construction of its processing facility in Ontario and for general corporate purposes. But the stock was down 17% at 56 cents. Shareholders weren't too happy about that, probably because they should be using revenue to increase in scale and operate rather than looking for more debt or capital from the markets. They should, at this point in time, be self-sufficient, and they still aren't, which can be seen in this Cresco terminating its VidaCann acquisition, highlighting that the industry has a focus on saving cash right now. It's not just the holiday season. There's been too much speculation. So a lot of these companies are trying to redo their agreements, make it more advantageous for how the current market is structured, because a lot of stuff has changed. Institutional investors are off to the sidelines. Angel investors are just waiting. Retail, mom and pop investors have lost a lot of money and are also on the sidelines. And so there's a lot of uncertainty in the marketplace as it pertains to capital. We can see that the Chicago-based multi-state operator, Cresco Labs, it's ending its agreement to buy Florida's VidaCann, becoming the latest U.S. cannabis M&A to unravel and highlighting the steps companies are taking to navigate a rocky business environment. We also saw Forefront Ventures, publicly traded out of Canada. They're divesting their Arkansas assets as well. But Cresco's decision in particular sheds light on how cannabis companies are scrambling to save money and focus efforts to their core markets amid a shortage of outside funding and falling cannabis stock prices. The vertically integrated company noted in a news release that it's saving additional cash through the sale of 2 cultivation and processing facilities in Michigan and Ohio for nearly $40 million. So this announcement signals 3 main takeaways: that transactions predominantly focus on equity are more likely to close. Companies will increasingly focus on the immediate core markets in light of challenged financial conditions, and cash savings are key to companies trying to carve out profitability quicker. So canceling this deal is going to save Cresco about $158 million to add to its balance sheet from both the termination and approximately $38 million from separate sales of 2 of the cultivation processing facilities. And so cash is no longer king, as the move supports the idea that all stock transactions in the cannabis industry are more likely to survive, if amended under the different current trading conditions, than deals that are largely announced based on more cash. In recent weeks, Cresco amended the terms of its all-stock deal with California marijuana producer Origin House and Curaleaf. They changed the terms of its planned all-stock purchase of the Select Brands and Curaleaf. Both deals are likely to close. An exception to this is MedMen's cancellation of its planned purchase of PharmaCann, which also was an all-stock deal. And so these companies are kind of focusing more on core markets, saying that they're going to continue to monitor the Florida market for future opportunities, but now they're looking at California, Illinois, Nevada, Pennsylvania. Ultimately, it's indicative of a new wave, a new sector where money isn't just speculative. It's going to be based on valuation. They're going to be looking at how you're generating revenue, and the novice investors are maybe lost a lot of their money. There's still some of them out there that are around, but some of the more savvy or knowledgeable or informed investors are going to be looking at a lot of this with a valuation perspective and not speculation. So it's interesting to see some of the debt, some of the equity, some of the rebalancing of ideas. Strategic partnerships are changing as the landscape changes. And as financing kind of becomes more constrained, we're going to see better valuations, better deals. And I think there will be more of a transition from the Canadian marketplace to the US, but from a valuation standpoint. We're just gonna have to wait and find out what happens. With that, we're gonna roll this one up. I'm Josh Kincaid. This is The Talking Hedge. By the way, if you enjoy the content, please show your support with the cushy gesture of $4.20 a month on the Talking Hedge's Patreon page. This will kind of help me spread the word. I've been asked to speak all over the world, from Toronto and Colombia, Spain, Miami, all over, Tokyo. But your support's important to me. I haven't monetized the podcast. I want to be as authentic and transparent as possible. I want to avoid conflicts of interest or even the perception of paid opinions. So don't forget to like, share, and subscribe, or pay me on the Talking Hedges Patreon page, or don't, and I'm out.